Hello traders, this is Frank Paul from FXM Trend speaking with you on Saturday, December 15th, 2012. Welcome to our latest weekly complimentary video presentation, as the title page suggests here, focusing on the FXM Trend Trader methodology. Just want to give you a quick rundown how our system works. You may have seen this before, but it's always good to have a refresher. The main indicator reading we're looking for is a 2-bar histogram slope reading on MACD across 3 consecutive time frames, daily, 4-hour, and 60-minute charts. This particular metric is what we call the 3M reading, which is tracked in our real-time momentum matrix market screening tool, which is available in the members area of our service. It runs 24 hours a day, 5 days a week, from the Asian session open Monday to the New York session close Friday. Now, you can never trade just signals. That's a huge mistake, because sometimes signals do light up across multiple time frames consecutively when you're in the midst of a difficult consolidation or corrective market. The momentum matrix cannot see nearby support resistance. You have to apply those filters yourself. So it's very critically important to understand that this thing generates signals left, right, and center all day long, but you can't act on all of them. They're just there for convenience, to be put into a proper context. That context is market flow or market structure assessment. And I wish we could find a way to program that all into coding logic to make it an automated analysis. It'd be really nice if an EA tool could do that. It's exceedingly difficult. It's one of those things that if you understand market flow as a reasonably experienced trader, or having spent some time practicing it and developing the skill, you can see it very quickly and easily if it's there on your chart. And the analysis does follow some simple rules, but it's very difficult to codify them into an EA tool. So for the time being, until we figure out a way to deal with that, that is the element of analysis which you as the trader have to apply. You have to bring to the table some good old-fashioned trading smarts and, if you will, manually applied analysis of the charts to make sure you're filtering those matrix signals. So when we have a continuation setup validated by this 2-bar histogram slope reading, which by the way is inspired by said concept explained in Dr. Alexander Elder's Trading for a Living book, then what we do is drill down to a pairing of the 5-minute and 1-minute charts, which sort of work together to provide us validated entry signals. And so if we're bullish, looking for a buy, we look simply for a bullish MACD, 1029 on the 5-minute chart, MACD above the 0 line. Then we drill down to the 1-minute chart, looking for a very low-level corrective MACD reading to resolve to trend, i.e. cross back above the 0 line from below if bullish, in line with bullish signals still aligned on all of the 5-minute and higher time frames that we use. Trade execution and management, we have detailed rules governing that. They are reflected in our EA tool, which by the way is absolutely not a trading robot. We have not built it to be used in that way. We do not advocate that kind of usage. We suggest that an EA tool needs to be managed like anything else in trading, and that means knowing when to turn it on, knowing when to turn it off. When you are turning it on, making sure to apply it in one directional bias only, not both. Okay, you're either long or short, never both, at least with this trading methodology. Remember, this is a trend trading system, and the trend is not going to change multiple times up and down in a single day. We're going with a daily chart trend, and usually that lasts for days, sometimes weeks. So very important to apply the filters as appropriate. So I'd like to walk you through a recent trade setup that reflected our trading rules here. This is for pound yen with a long bias on Wednesday, December 12th. A nice round number there in terms of the time on the clock when the 1-minute entry signal materialized. Just a coincidence. There's nothing special about hourly readouts, but this one happened at 8 a.m. on the 1-minute bar. Entry price of 133.28. Our initial protective stop is always 20 pips below entry, spread included. We have analyzed this numerous different ways. We've used low-level dynamic stops, we've used wider stops, we've run them all through strategy testers over long periods of time, and have concluded that the best, most optimal choice for this trading system is just a default 20 pips. Now, of course, that's for conventional pairs. But those with unusual pip costs, such as euro pound, you can tweak that a little bit. Euro pound has a pip cost of around about 1.6. So, of course, you could simply divide by that, 20 pips divided by the pip cost for euro pound. I hope I said that pair correctly, euro pound. And that would give you an initial stop, let's say, of what would it be? I think it would be 12 or 13 pips, something in that range. So just just an important note, though, if you're applying this thing with pairs that have pip costs that are outside the norm, and by that I would mean less than 0.8, more than 1.2, something like that. Anyway, just to provide a quick recap here, on the same day the trade was entered, the P1 order, the first of 4 lots in our 4-lot scaling out preferred methodology, was struck at 133.58. I'm not factoring in dealing spread here because it made no difference to the outcome. Okay, if we actually got in at 133.31, then we got out at 133.61. Those results are still good. And in the same day, the day trade target, which is obtained by adding the 5-day average daily range to the actual low for the day, that target at 133.79 yielded profit on the P2 portion of the order for 51 pips profit. The swing trade leg closed sometime later for profit of 129 pips at 2 times ADR from the low of the day in which the trade was entered at 134.57. And as we head into the weekend, the position trade leg, which we manage by way of a daily bar trailing stop methodology, that's still open. As I record this, it's sort of hit around 160 pips floating profit, so that's not a firm fixed number. It's not a closed number. It's just sort of an approximation. By the time you see this video on the weekend, you'll see what the real closing value is, and it might be different from that. But the point is it's still open and profitable, and most of all, risk-free, which is a really nice position to be in. So as to whether you trade full lots on each leg or have to divide a total prudent position sizing into 4 equal sized parts will determine whether you add up all these pips, and it's, well, we've got 30 plus 51, that's 81, plus 129, that's what, 210 plus floating profit of number there's 160, so 370. So that looks like 370 pips, but if your alternative is a single lot all or nothing, then of course you have to divide that 370 pips by 4, which would be about 93 pips. So it just comes down to the size of trading account and lot sizing and things that you work with. So I'd like to walk through the trade setup really quickly. Before we do that, please do check us out via forexmentor.com/FXM Trend Trader if you're at all intrigued by what you see here and would like to find out more. Of course, you can also email me at any time via frank@forexmentor.com. And you don't have to be a member to follow us on our Twitter page at FXM Trend Trader or twitter.com/FXM Trend Trader. That's how you can find out more if you're so inclined. Okay, let me hit the pause button, bring up the charts, and quickly walk through the setup in just a minute. All right, we're looking at 4 charts in tile display mode. By the time you see this all condensed down to a single display screen, it's probably too squished. So what we're going to do is just maximize each chart screen and go through them one at a time. And I'll begin with the weekly chart. Even though we don't specifically track its readings in the momentum matrix, it's not a core time frame within the setup, we do suggest looking at it, paying attention to it, because it does provide some important context. I've drawn a dashed vertical line through the weekly bar for December 10th, which on the weekly chart, of course, is where we found this trade. Now, I'm just going to point out something really glaringly obvious, and that is that we had a hugely significant resistance on an old swing point high from March 19th in the background, 133.49. Now, what's going through your mind here as you look at this is you say, okay, do I want to just sort of chicken out for the time being? And there's nothing wrong with that. The logical thing to do here is to wait for price to achieve probably a daily bar close above this resistance level. On the weekly bar, as I record this, we're closing in on 134.92. That is above the old swing point high. So that even though the Heikin Nashi bar doesn't really show it, that is an upside. Well, let's just quickly flip into real candle mode here. There you go, big up close above that resistance. However, the entry price was 20 pips below that level. So that's one of the sort of gutsy decisions that you have to make from time to time. And I'll just tell you how I approach this personally. It's not very scientific, but nonetheless, if I see a really significant resistance level like this, okay, and I'm looking at a potential buy from just below it, I will assume that price is going to make the upside breakout if I see a really strong confluence of events. One of them being, let me just get rid of these arrows here. One of them being the momentum reading on the lower time frames that we're looking for, daily 4-hour, 1-hour chart. But here we also have an example of a bullish 2-bar MACD histogram. Okay. Now this again is from Dr. Elder, and the way it works is that relative to the current open, you look back over the last 2 histogram bars. In an uptrend, what you want to see is evidence that the most recent histogram bar on the close is higher than the one before it. Just 2 bars, that's it. Okay, it's a very short-term momentum reading. Doesn't go back over months and weeks, etc. It's just 2 bars. So you can see that the bar for December 3rd was a little bit higher than that from November 26th. So even though we're not specifically looking for a bullish 2-bar histogram slope reading on the weekly chart, we find it, which nicely corroborates the readings lower down. More importantly, I would suggest, is that we have clear evidence of bullish market flow. That is an impulse wave up to a swing point high, retracement to a higher swing point low, another higher swing point high, higher low, higher high, higher low. We've got clearly bullish market flow unfolding into this week on the weekly chart. So I'm going to go ahead and make the assumption that price should at least give me the 30 pips I'm looking for, which makes this a risk-free position. That is the hurdle every single time. Because when we get 30 pips profit, we close the scalping portion. Well, it's not really a scalp. 30 pips is more than what most people shoot for, but we call it a scalping objective. And when we hit that objective, then the other 3 remaining lots have a stop trail to break even, and those 3 lots then become risk-free. That's the hurdle. Every single time we enter a trade, we're looking for 30 pips, not to generate big profit, but to at least make the position risk-free. Okay, so the weekly chart suggested resistance. I thought that price should break up and through that. And then on the daily chart, I got lots of things going on here. I was originally expecting a more significant retracement in the downwards direction. I've drawn a Fibonacci here. That was later proven invalid, and that's just what happens sometimes. It was a case of mistaken identity. What I thought was a downside retracement ended up actually being consolidation. And this is why it has been really tricky to trade the markets applying a trend following methodology over the past 2 weeks, 3 weeks. You see many instances of this scenario, whether it's the weekly chart for dollar Swiss in the downtrend or the daily chart for pound yen. I mean, our service launched pretty much right here, November 19th. And we were greeted by the market with this multi-days long go nowhere scenario. Okay, and that was why we came up empty-handed, didn't have too many opportunities to speak of for a period of several weeks because the markets were consolidating on quite a few pairs. So anyway, it was a consolidation rather than a downside retracement, but what helped us tilt back in the upwards direction is that we had this 2-bar slope reading here. Very small little bars, but the bar for December 11th was higher than that for December 10th, which means that heading into December 12th, it was a bullish momentum reading here as well. In case you're wondering what these other indicators are, the middle panel here is a 5-day ADR calculation, which is the same as average true range in the MT4 platform. Just making sure that you change the default setting from, I believe it is 14 down to 5. So MT4 5-period ATR is the same as just the generic 5-day average daily range that I've programmed here in Pro Realtime. And then this thing at bottom is just basically a calculator of projected high or low for the day, which it does by adding 5-day ADR to the low for a projected high if we're bullish, or subtracting 5-day A from the actual high for a projected low if we're bearish. So you only ever look at one side of this thing. Okay, so that's helpful. And then as we drill down to the 4-hour chart, I do now have a 4-hour retracement underway per the annotations. Swing point A, 8 a.m. on the 10th at 131.68. Swing point B, 4 a.m. on the 14th today at 135.41. Price is pulling back. It looks like we're looking for an uptrend continuation move into next week. First a retracement down, then a swing point low, then a bounce back up. But this dashed vertical line shows you where we were on the 4-hour chart. Beautiful, smooth histogram slope reading here. Again, we only required on 2 bars, but it doesn't hurt when we see a nice smooth bar over bar reading extending back over time. That's helpful. Not required, but helpful. So there we have it. No, we don't. We need one more chart, the hourly chart. There we go. And we can see here too, histogram bar, higher histogram bar. So by the time we get to right here, 8 a.m. on the 12th, we've got the 3M reading, which is bullish. Bullish histogram slope readings on each of the daily 4-hour and 1-hour charts. So then what we do is we pull in, I'm going to pull in first of all the 1-minute chart, because what we're looking for as an entry trigger potentially is first of all a counter trend MACD reading on this time frame. This is the 10-29 MACD keying off the moving averages I've got plotted here, 10 and 20 EMAs. And so we're looking for a bearish reading, which on my chart paints in nicely as a counter trend red. And so when MACD crosses back above the 0 line, which is the same thing as the underlying moving averages crossing above 10 EMA, above 20 EMA, we have a potential entry trigger right there. And that is, again, 8 a.m. GMT, December 12th at 133.28. The P1 target is 30 pips above, which was hit right here, 8:49 a.m. So less than an hour later, we got 30 pips and a risk-free position. And then, whoops, that's not what I wanted to draw. The other horizontal green dash line here is the day trade objective for our P2 position, which is achieved right here, 10:15 a.m. So a couple of hours later. And then the swing trade objective, which I've drawn here at about 134.57, that is derived by adding 2 times the ADR figure in effect on the day the trade was executed, added to the actual low for the day, and it might take a couple days to get there, so let's just follow this thing through. And it was achieved right here. This is now 6:15 p.m. GMT, so it's the same day actually. We were fortunate to get a really good move there. Usually a swing trade objective you have to wait for more than a day, maybe 2 to 3 days, but 6:15 p.m. GMT, December 12th. There we go. So all in the same day, we got 30 pips plus 51 pips plus 129 pips. And by the way, again, just to reiterate, when price comes up to this P1 target here, that's where we take the initial protective stop and drag it to break even. So what you want to see is the fact that price cleared this trailed stop all the way through, and it did. Sort of went sideways for a number of hours, kind of even dipped down, but at no time did price come down to this trailed stop right here, and it ended up a really nice position. I won't go over the method for managing an open position on the daily chart. It's our 3-bar trailing stop technique, which I was lucky enough to learn about from Dick Thompson, a fellow Forex Mentor member. And suffice to say that for now, we don't have any call to action, I don't think, here. We would drag the stop based on further progress on each daily bar, looking back over the past 3 closes, and I'll leave the rest of the details for some other time. But in any event, we're sitting on a profitable position. As I record this now, we have a closing price 134.93, so that's yeah, about 160 pips above entry. Nice place to be. Now if you're like some of our members, you don't like to hold a position open into the weekend, you can go ahead and close it. That's not my MO. I like to just say, well, if it's risk-free and it's profitable and the trend is still intact, then there's no reason it shouldn't continue intact on the Sunday afternoon open. So that's just a different way of approaching it. Anyway, that's it for our review today. I hope it's been helpful and maybe stimulated some fresh thinking for you in terms of trading ideas, reading the trend, etc. Again, feel free to check out our public information page, FXM Trend Trader, or if you have any questions not answered there, feel free to email me via frank@forexmentor.com. Thanks for joining us today. Enjoy the rest of your weekend. Happy holidays to you, and we'll talk to you again hopefully very soon. Bye for now.